Good morning. It's Tuesday, the 8th of October, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital. The take, the fork on the road for Ola. So the problem's at least one for Ola, the cab-hailing company turned electric vehicle maker, started with a fork, not the kind you eat your food with, but the piece of metal that joins the handlebar of a two-wheeler to the front wheel. That oversimplification, if so, is mine. Ola Scooter and technology was acquired from a Dutch e-scooter company called Itergo, and the same technology and components were rolled out in the Indian market in August 2021. A major exception seemed to be the battery pack, which was now fixed as opposed to the removable in the original. Automotive reviewers call the Ola S1 Pro a better scooter than the original and India's best performing, fastest and even best looking scooter. Till the fork started to collapse soon after and complaints gathered steam in January last year. Users shared pictures and even started a change.org petition against the company. Some users pointed out, and automotive journalists I spoke to concurred, that it was quite obvious that this design was never meant for Indian roads and Ola should have done a proper recall and fixed the forks. Instead, in March, it offered an optional upgrade to strengthen the fork further, even while insisting the concerns were unfounded and its components were engineered under extreme conditions and built for greater loads. If the concerns were unfounded, then why change? Anyway, maybe I read some of the posts only, but they appeared largely of the kind that was seeking the company's help and assistance. Nevertheless, Ola's response was denial, obfuscation, and attack, as is quite evident from the March note as well. A trait that continues to the present day as a social media battle surfaced over the weekend between the founder of the company and a stand-up comedian who posted pictures of scooters awaiting repair. Now, there are several lessons in this. First, there is a reason why products that are inherently capable of causing harm to its users, like two or four-wheelers, have to go through severe testing and are literally placed under much tougher standards than most other products. One of the criticisms Tata Indica faced in its early years, as did Tata Nano later, was that these products was not sufficiently tested. The satisfaction that Tata Indica was India's first Swadeshi or local car would not really help if the car broke down in the middle of nowhere with no easy mechanical fix. Nor did it help that Tata Nano was the cheapest car designed and made in and for India when it experienced multiple problems, including catching fire unexpectedly, all of this happening in 2010. But in both these cases, Ratan Tata, to his credit, did not launch a personal attack or blame competitors and social media trolls for his misery. Thankfully, there were no social media trolls or social media at that time. The problem may be with a fork or a battery, but it gets compounded when clearly there are not enough repair staff to attend to the problem or service center capacity. Now that reflects inexperience and arrogance or the assumption that a two-wheeler is like a mobile phone, use and throw rather than expect a service center to respond and repair. Traditional automotive makers understand this cycle better, that setting up a dealership network which sells the vehicle should go along with servicing capability and capacity as new vehicles are launched. Ola instead went for a direct-to-consumer approach, which has evidently backfired because it now says just 2 weeks ago that it's going into a multi-brand retail showroom model. There are other problems there, which I'll pick up at a later date. But the bottom line is that the automotive industry is a tough one for serious players, and even the best make mistakes all the time. There is a shortage of electric vehicle technicians today for all classes of electric vehicles, including cars, in which case you should not be dumping product in the market without having the same proportionate and trained service staff to respond when things go wrong, unless you didn't really budget for it in the first place. And then there is price. Ola is now selling its S1 scooter starting at 49,000 rupees. Seems like a great deal, except that this was earlier advertised as starting at 80,000 rupees. That's the same model. And the prices are still showing on several auto websites, by the way. Now, this is irrational and detrimental to the company and the industry because low prices means compromises along the way, including the cost of setting up a spares and service network. The company could, of course, argue that investors are paying for these market entry or penetration strategies and discounting is a cost that they can bear. That's technically correct, but practically improbable, as eventually the mistakes of the past will catch up with you. Because unlike in other digital industries, your job does not end with customer acquisition, it begins there. And the top stories and themes for the day. The stock market's longest losing streak in 2 years could continue. More global brokerages cut India weightage, increase China. India gold prices hit record highs. Car inventories at dealerships now cross a record 80 days. Oil prices rise. British Petroleum or BP now cuts back on renewable targets, shifts back to oil. And how wealthy investors invest at times like these.
This is a Core Report with Govindraj Ethiraj.
Stock markets tilt and wilt. The stock markets rose somewhat encouragingly at the beginning on Monday, but quickly gave up gains to sink quite sharply as the sell-off continued. The indices fell for the sixth straight session on Monday, their longest losing streak in 2 years, as concerns over Middle East tensions and the extended impact weighed on the market, according to Reuters. The Sensex was down about 638 points to close at 81,050. The NSE Nifty 50 fell 218 points to end at 24,795. Most Nifty 50 stocks were dragged down. There are no clear global triggers apart from the main negative ones that we've been talking about. Chinese markets reopened today and all eyes are on them to see if they will rise further, which is of course not good news for India. Stock brokerage CLSA, the same folks who came up with the Modi stocks theme, have now said that they're cutting India overweight to 10% from 20% and raising China to 5% overweight, according to the Economic Times. According to the CLSA, there were three whiches: oil price, new issuances, that's the IPO boom, and retail investor appetite. If you follow the core report closely, we've been referring to the IPO boom as a threat in the horizon, as well as, of course, oil prices, which is now quite clear and apparent. CLSA analysts quoted by the Economic Times said after India's 210% outperformance of China, relative valuations are stretched. Yet strategically, we argue that India still offers the strongest scalable emerging market growth story. Last week, DBS Group also said India will underperform China for the rest of 2024 following Beijing's monetary and liquidity measures. A DBS Group analyst said that India has performed strongly and we're looking at other markets. China and ASEAN could actually outperform, and India is actually quite a domestic liquidity market. Gold prices hit highs. While stocks dipped and investors reassessed their equity exposure, some quite likely started buying gold, sending gold prices up in India. Here, gold prices have now hit a fresh all-time high of 78,700 rupees per 10 grams on Monday, thanks to strong domestic buying and also reflecting international gold price trends. On Friday, gold had settled at about 78,450 per 10 grams, according to the Business Standard, which also added that silver, however, declined 200 rupees to 94,000 rupees per kilogram, according to the All India Sarafa Association. Traders attributed the gains in gold prices to an increase in the domestic demand by stockists and retailers, and also the decline in equity markets obviously aided the rally in gold as investors move towards safe haven assets, and this presumably is also happening globally. And then, of course, there's the festive season, which we will come to a little more shortly. Oil prices are now closing in on $80. Oil prices almost touched $80 a barrel as the markets now waited to see if Israel would launch a retaliatory attack against Tehran for a missile attack last week. Brent has now risen about 2.4% after jumping the most since January 2023 last week, according to Bloomberg. Iran's attack on Israel has raised fears over an all-out war in the Middle East. On the other hand, there are questions about the demand outlook, especially from China, the world's largest importer, and of course, the other issue of excess supply. Meanwhile, fortuitously, BP, once British Petroleum, has abandoned a target to cut oil and gas output by 2030, according to Reuters. In 2020, BP's strategy had pledged to cut output by 40% while rapidly growing renewables by 2030. And then it scaled back the target in February to a 25% reduction. That's from 40 to 25%. And now it looks like it's pulling back further. The London-listed company is now targeting several new investments in the Middle East and the Gulf of Mexico to boost its oil and gas output, said Reuters. Car stocks pile up further. Speaking of festive seasons, India's automotive industry is desperately hoping this year's festival season will come as a savior. Meanwhile, car sales have dropped by 19% in September or last month. Now, this has been attributed to several seasonal factors, one being the heavy rainfall, which kept people away from visiting showrooms, and other factors like Pitra Paksh or Shraddh, a 16-day lunar period when people usually don't purchase new products in India. In August, inventory levels were at 75 days, totaling about 780,000 vehicles valued at about 77,800 crore rupees, as we've been reporting in the core report. The Federation of Automobile Dealers Association, in its monthly update on Monday, said the near-term outlook for automobile retail is cautiously optimistic as both Navratri and Diwali fall in the same month. Interestingly, the overall retail sales for September declined about 9%, with all the other categories except for three-wheelers and tractors showing a sharp decline compared to the same time last year, according to the business standard. So, which means three-wheelers and tractors have done well. I reached out to C S Vigneshwar, the newly elected president of FADA, and I began by asking him why dealerships were taking on more inventory even if the sales were not moving. Vigneshwar joined me from Coimbatore.
It's kind of a situation where we probably need to listen to each other, hear each other out. I'm talking about FADA and the manufacturers. We've been voicing our concern regarding the increase in inventory for the last 4 to 5 months. We've been voicing it out quite vocally from FADA because it's a source of concern. Our usual inventory is about 3 to 4 weeks, but it's about 85 days right now. And the manufacturers also have their point of view, which I really appreciate. Their point of view is that this festive season, Navaratri and Diwali, is going to be for about 42 days. It's probably a very condensed festive season. And the manufacturers tell that we can't manufacture vehicles just for 2 months and we can't take up our production capacities multifold. So they say that this addition and slow climate inventory is to make sure that the customers are catered to, their demands are catered, which I also empathize with. So when you look at our situation in the last 1 week, when we've been speaking to our dealer partners, it's quite encouraging because the inquiries have gone up fourfold. And hopefully this would translate to better conversions and then to bookings and then retails. I'm quite confident it's going to really be a bumper season. But I don't know whether it is going to solve the inventory problem fully. But I think most of the inventory problems should be solved by the looks of it and by the market sentiments.
So when you say bumper season, would you compare, let's say, the proportionate rise you see in any year, or is this year likely to be any different?
I'll give you a run-up to it. The run-up to this year has been a long and protracted elections, followed by a crazy heat wave. Summer was really bad. And then we've been having rains and floods all over. So the customer has not been finding an opportunity to go out and buy. So I feel that there's going to be some pent-up demand because right now the sentiments are good. You got festivities to celebrate with your family and friends. You have decent weather. You have all the elections are already over by now. So you don't have any other reasons not to go out and buy. So I'm thinking that apart from the pent-up demand, also the very condensed festival season will help in making sure that customers walk into the showrooms and walk out with vehicles.
And is that the sense that you're getting as well? I mean, on ground, apart from what, let's say, dealers are telling you or other dealers are telling you or manufacturers are telling you?
So we have our own dealerships and we have seen our own dealerships inquiries have gone up, is looking quite strong. Some brands have some leeway from the fact that some brands are carrying bookings. Some brands are not carrying as many bookings. So that's where the worry is. But the first 7 days of this month, if there is any indication, I think it'll be a great festive season.
So coming to the brands, so clearly some models like Mahindra's latest model has seen a huge booking surge. And there are other Mahindra models also doing well. And there are other cars like hybrids, for example, which have waiting lists. But that proportion of those, in contrast to the entire universe of car models, is much smaller, isn't it?
It is smaller. It's not an indication of the whole industry. A small portion of it is under bookings. Most of them are not. It's a great time to be a customer right now because the demand seems to be slowly climbing up. But the moment the demand hits its peak, then you'll be seeing the discounts actually start coming down. Right now, the customer, unlike in the last 4 years, is being able to go and get some good deals and also make sure that the vehicle of the customer's choice is available. Today, our inventories are flushed with different colors, different suffixes, different models. So the customer can actually come and choose. Let's say some time ago, last few years, I know that customers have walked in and they had to compromise either on the color or compromise either on some kind of the suffix of the vehicle, and then they had to walk out. But today, the customer is really king, where the customer can come there and get a choice of whatever vehicle the customer wants.
Right. And last question. So how are you seeing the post-festive season? As in, do you feel that the inventories that have been gathering or climbing for the last many months would start evening out? And are you optimistic at all on that score?
I'm optimistic that the inventory is going to come down. I don't know exactly how much it will come down by, but it will definitely come down. And it's also, as an industry, the manufacturers, the dealer, all of us need to work together for a healthy dealer ecosystem. The manufacturers also clearly realize this and they appreciate it. They also know that they can't, keep sending vehicles and dispatching vehicles to us endlessly. There's a limit to it. And I think we are already reaching the limit. But this limit coincides with the high season. That's what the industry also has planned, apparently. And it'll be great to not only sell more vehicles, but also see our inventories come down during the season.
Right, Mr. Vigneshwar. Thank you so much for joining me.
Thank you so much.
How do the wealthy invest? When markets give up several thousand points in a week and panic starts to set in, as it usually does, it's also a good time for reflection. It's not easy, but it is important, and perhaps the only time that investors could take some pause and reflect. And perhaps one good place or person to pose this question to is a wealth manager who manages billions of dollars, but mostly for very high net worth individuals, the kind who don't sleep when markets fall 4 to 5% in a week, but at the same time want to see their wealth grow over time. I reached out to Nitin Jain, founder of the Neo Group, a wealth management company that advises or manages about $3.5 billion of assets, and I began by asking him how he viewed the markets right now on behalf of his clients as a long-term investor at this time.
Obviously, we are in a very, very positive cycle, very positive economic cycle, and that's getting reflected in all kinds of prices across asset classes. Of course, the most talked about is equity markets. I think the kind of run that we have had in stock markets for the last 3-4 years is one of the 5 largest bull market that I have seen in 25, 30 years of my career. So that also is driven by the fact that the last 4-5 years, the earnings growth has been very. So it's not a bull market without any fundamental basis or purely on speculation or purely on liquidity. And just to give you a number, in 2020, if I'm not mistaken, the Nifty earnings was close to around 410 or 420. So that 410, 420 is most likely going to be more like 1150 to 1200 this year, FY25. So there's 3x jump in the fundamental earnings of the index. And that is also reflected in the rise in the index value. Right? But there are pockets, I must caution, there are pockets of exuberance that are getting created now in the equity market particularly, especially in the small and mid-cap segment. I think the primary markets have been very, very strong. So I do think at this point, we should be slightly more watchful on the equity markets. I think over the next 5-10 years, the difference in returns for good high quality companies versus not so good, I think will be significant. So that's one red flag for me right now as we speak. The second market, which has become very interesting right now, is the credit market. And the credit market, obviously, we have had a lost decade, frankly, from 2010 to 2020, if you think about it. Most of the lending institutions, particularly the banks, were really struggling for the first half of the decade. 2012, 30, 2019, 20, I think we were practically in a credit crisis in one form or the other. First, the banks went through their own NPA cycle, then the IFS happened, and so on and so forth. But what that has led to, and I should also add the IBC code coming into play, the bankruptcy code coming into play, what that has led to is that the credit markets have strengthened dramatically. Corporate leverage has come down meaningfully, and the credit culture is. So, as a combination of these 2-3 factors, what has happened is we are probably living in one of the more benign credit environments that I have seen. What that translates into is very good risk-adjusted opportunities from a supplier. So I think the credit market is a very, very interesting and a very strong market as I see it right now. Real estate, again, I think is something fascinating, something really fascinating happening in real estate. I think it's become very, very market-led. And strangely enough, if you go back and hear the narrative in the last 7-8 years, it was always about more affordable real estate doing better. I'm talking about the residential. But what has happened is, strangely, the luxury market has taken. So actually, it's right now, if you see all the developers, all the builders, they're all trying to create the higher end of the segment, particularly in the big metros, because that's where the demand is really taken. In fact, probably it's a wealth effect of stock market. Rich people are making a lot of money in stock markets, and that wealth creation is now starting to go into real estate. So that looks like a very strong market, more so in the higher end of the segment. It's very interesting times, but very, very positive.
Right. So you said stocks, credit, and real estate. Do you have any overseas international exposure as well?
It's still a very small part of our client portfolios, but I think, thank you for pointing that out. It is becoming a very strong theme. most of our clients are not talking to us about how they can diversify into dollar assets. And partially it was done by investing in gold and some of the funds in India that were launched in the last 7-8 years. But now people are actually looking at gift as a very viable option to invest offshore. And we are seeing a lot of interest, particularly in US equities. So I think US equities, even within US equities, I would say the tech part of the US equity is getting a lot of attention.
Right. So if you were to, let's say, rewind 3 or 4 years ago and then look at the kind of allocation you would have done. I know this fund was started later, but say if you would have done a certain allocation, and that allocation today has reached this point where clearly equities have done much better, as you said, than perhaps imagined. Real estate has also done well. And there are other opportunities which are more, let's say, balanced, defensive, and so on. So, but if you were to build the same portfolio today and starting from scratch, would you build it the same way or differently for the next 5 years?
It will not change dramatically, but for sure, I think the allocation to equity might come down. I have spent a large part of my life trying to explain to people why they should increase their allocations to equity. For the first time, I think I have to wear the other hand where everybody who's talking to me is saying, why not go 100% equity? And I think remaining more balanced is, I think, the long-term key to being successful in managing. I've never seen this kind of euphoria and bullishness that even people who are new to markets are experiencing right now. And I would probably be more like EQ8 on equities, very heavy on credit, as I said to you earlier. I would not be very allocated to real estate from an investing perspective because, one, I think it's a very cyclical industry, and with the kind of cost of capital for most of the developers, I think returns eventually don't turn out to be as exciting as they look. That's opportunistically, we will look at some of those things. So, Govind, what has happened is in the last 3 years, we have had a major bull run in the public market. And strangely enough, we have had a nuclear winter in private. Just imagine, in public markets, including the SME, IPO, etc., people are raising thousands of crores so easily, right? But young companies which are doing very well and where the entrepreneur is sold the opportunity big, suddenly you're finding, at least a couple of months back, you're finding that there were hardly any money flowing to them. And that was the after effect of the 2020-21 before the Nikas of the world, Zomatos and that, because they had raised Byju's. There was so much money that was raised and lost in that phase or didn't perform to the best of expectations when the IPO happened, that suddenly that market had pulled up dramatically. So I do think the private equity market right now, or the private markets in general, have become much cheaper than the public markets. So there should be some tactical allocation that I would like to make from public markets to private markets even within it.
Right. So if you were to look at, let's say, the habits of well-to-do investors and all that you've seen, what would you say are the 2 or 3 good lessons that you would like to share from them or from this set of class of investors for those who are perhaps not so, let's say, wealthy, and yet would like to adopt a similar strategy?
More than a principle, I would say a couple of philosophies that I have learned from some of these very, very successful people. One, always focus on the upside as well as the downside. I think most investors actually focus a lot more on the possibility of the loss than the possibility of the profit. And size your bet, size your investments accordingly. But I think not investing in opportunities that you're convinced about and you see great outcomes because of fear of loss, I think is a sure short way of not making enough wealth for yourself. So taking risk in a calculated way in opportunity that you see, I think that is one thing that I found as a common theme across all the successful investors that I've come across. And the second is an element of discipline. I think not getting carried away in a bull market like this, sticking to your asset allocation, sticking to your portfolio mix of fixed income, credit, real estate, gold, and equities, even when everybody in the world is now telling you, why do you invest in fixed income?
Right. That's very useful. Nitin, thank you so much for joining me.
Completely a pleasure. Thank you, Govind.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.